Welcome back, friends. Let me review the US markets and where they stand at this point of time. The US markets have been rising over the last couple of years on the back of the AI theme predominantly, assuming that a good amount of productivity gains can result from artificial intelligence. And definitely, I am also one of the people who would uh, agree to the tremendous technological advancement that AI is going to bring about in terms of increasing productivity across the board. Of course, it's going to result in a reduction in manpower as well, which can be effectively utilized back into artificial intelligence in many other ways, such as content creation. So I don't think that the losses themselves need to be themselves be such a big worrying point. However, there is another school of thought that the geopolitical pressures and the increase in energy prices resulting from the US Israel Iran conflict um, will keep the energy prices high and therefore inflation on a much higher level and higher trajectory. Of late, you must have seen that a lot of the hyperscalers, the AI companies, growth companies, trying to raise a lot of funds to be able to finance their data centers, the various AI capabilities, AI agents, tokens, and the cost of making them, including the cost of the microprocessor chips, which, of course, have been finding that the demand far exceeds the supply, and therefore the prices keep shooting up, not only of the chips, but also of the semiconductor companies themselves. So, because of this increase in the energy prices and the inflation, you have found that the US Federal Reserve has been loath to reduce interest rates. It has now tried to go for a pause, and there is some possibility that in September, Kevin Walsh and his team may even consider a slight increase in interest rates. That's a small probability, but let's see how it happens because Kevin Walsh being having appointed by Trump to come and reduce interest rates, well, that's not what he would also be looking for. And besides, there are other things which are working in the background. An increase in interest rates, therefore, could be just nominal uh, till more data becomes available. You would have been surprised to note that oil prices has not gone as elevated even in the midst of a very heavy US Iran conflict. They have remained around 80, 85, $90 predominantly in this range. There has been such a tremendous demand for funds, and the supply has, however, not been so commensurate as the demand has been for these AI related investments by the hyperscalers, by the Metas, by the Microsofts, Googles, Alphabets, Amazon. So the only way that the demand and the supply can catch pace with each other is if the yields go up, right? Otherwise, there is no way they can come to terms with each other. And the only way that the yields can go up is they have been supported by this high inflation. So it all makes sense. There's also great demand for funds, far exceeding the supply. So every reason for the yields to go up further. 10-year bond yield already near 4.69%, and there is if we find that the yields go up further in the medium term, particularly if the 10-year goes towards 5, used as a very important discounting factor when you consider the discounted cash flows for growth companies, you may find that the discounted value of the cash flows over a period of time begins to come down. Maintaining the same price earnings ratio, if the earnings are not commensurate, you will find that the price of various AI related stocks could also start coming down. So, what I'm trying to say is that there are two things, two factors, two engines on which this AI story and the American economy and American stock market and the world stock market is running at present. One is the preeminence of the United States as an AI engine, along with, of course, South Korea, Japan, and the likes, and Taiwan. And on the other hand, we have the skepticism around interest rates being maintained at the current level. There is every chance that they may go up in the near term. And should this happen, you'll find that cost of borrowing for the growth companies, AI growth companies, goes up. If this cost goes up for the AI related investments, then there would be a question as to whether they are able to generate revenues commensurate with the higher borrowing costs. If they are unable to justify, then this can cause a tremendous recalculation of their capex investments in data centers and various AI related investments. This can increase in the interest rates can cause the apple cart to turn, and the AI story, although intact, it would remain for as a major technological revolution for times to come. But the AI valuations could then get impacted, and this may lead to a reduction in capex spending, which can impact investments not only in the United States but across the world, because the various hyperscalers are investing not only within the US but overseas as well. And once these investments start coming down, they could have an impact in other countries as well, such as India, for example. There are a lot of money that the hyperscalers are putting in India. So they may slow down over there as well, along with real estate companies which have put a lot of money into data centers coming up in various parts of India and various other parts of the world. So it's a chain reaction, it's a vicious circle that may come to happen and can cause a tremendous amount of pain. It has historically also, it has been seen that when the bond yields go up so furiously, they are not liked by the stock market. So although the Federal Reserve has kept the interest rates constant at this point of time, there is every likelihood that the bond yields may go higher from here. Bond yields go higher, then you find that the discounted value of cash flows comes down, the stock prices get impacted, the stock valuations get impacted, and yes, the AI story can get impacted as well, because the amount of money that was rushing into the AI companies may not remain at that same furious pace as it was. So be mindful of this fact. There are these twin factors as far as countries such as India is concerned, which have not participated in the AI trade. They saw their stocks of the software companies go up last week because the AI story was dwindling. So software as a service, or SaaS companies as they are called, will remain relevant to adapt AI for the various companies within India, across the world. And the relevance will not be lost just because AI has become such a big source, because applying AI to various applications and particularly enterprise applications will require the Indian software companies to continue to maintain their hold. In this scenario, we have already a rather difficult interest rate scenario to look forward. And we have various timelines where this whole AI story and the investments that have been coming as a result of AI could get impacted, and along with that, the stock valuations. So we have prepared these various timelines, and although the correction in the semiconductor stocks that we have seen over the last few weeks can just be labeled as a correction, not a crash. Yet I think that this correction can repeat itself over the short term and can bring more pain with it. So we need to be very, very cautious going forward. The very, very short-term outlook remains bullish. Particularly, President Trump has today halted further strikes on Iran. So that's a bullish factor. Markets should resound and should be happy as the world financial markets, as they get ready to open on Monday, but how long this will sustain, not in terms of just the geopolitical pressures, but in terms of the interest rate pressures, is going to be a very important factor to look forward to. I believe we may see some calm before a new set of storm lies ahead, and people realize that their investments are not fetching the kind of returns that they had got accustomed to in the past. So it's a very difficult scenario for the world, and short term looks good, but in the medium term, good amount of pain lies ahead, and you as an investor would be much much concerned that your investments, which have been yielding so much of dividend over the past few years, that same may not sustain. In fact, it may start going the other way around. Be very cautious. The SpaceX IPO and it's going underwater and its valuations below the IPO price itself is and the fall in the semiconductor stocks. These are all the reminders that yes, this rally cannot go only one way up. It's got to turn down, and I think the turn is going to come sooner than what you and I anticipate. It's very much writing is on the wall, and it's just a question of just some time away. To get to know what are those timelines for the US markets, you may join our Prime Plus Telegram group. For the Indian markets, to join the Premium Plus number to get in touch, you may WhatsApp us 982 086 1044. Have a great week ahead. Take care. Bye bye.